What we're going to talk about in this session relates to audit planning and the types of audit tests. Keep in mind that what we're doing is we are in the beginning phase of the audit. In the beginning phase of the audit, one of the first things that we need to do is to have an acceptance between the client and us in regards to the audit. Now, there's some very specific steps that we're going to be talking about. We will then talk specifically about some preliminary activities and then finally planning the audit. We want to consider client acceptance both from a new client as well as a continued client. If this is a prospective client, what we need to do is we need to initially obtain and review financial information. We want to inquire of third parties regarding the client's integrity. Keep in mind that one of the things that we're going to be doing is talking to the predecessor auditor. We will consider unusual business or audit risks, determine if we're independent, determine if we have the technical skill set to complete the audit, and then determine if any acceptance violates regulatory code of conduct issues. One of the steps that we have in regards to a new client is to ask permission to communicate with the predecessor auditor. Now, we cannot talk to the predecessor auditor without permission. If the prospective client does not give us permission, this does not preclude us from taking the assignment. However, it may cast doubt on the integrity of management. But let's assume that we are able to talk to this predecessor auditor. So what we're going to do is we're going to make inquiries of this auditor in regards to information that might bear on the integrity of management, any disagreements that the auditor had with management related to accounting policies, procedures, or significant matters, any communication that the auditor had with governance as well as management regarding non-compliance as well as significant deficiencies and material weaknesses. We also want to understand, based upon the predecessor's auditor's opinion, what the reasons are in regards to changing an auditor. There's a lot of good reasons to change an auditor, so this should not really indicate that there's a problem, but we clearly want to make sure that we are not getting involved with a client that is shopping for an opinion. If we are continuing a client, we certainly need to evaluate this client periodically. We can do this near the completion of the audit or at any significant event. We want to make sure that there are no conflicts regarding accounting and audit issues or significant clients. We also want to make sure that there's no disputes over fees. Keep in mind that we cannot do the current audit if in fact there are outstanding fees from the prior audit. This is an example of an impairment of independence. Once we have an engagement, we need to determine the audit engagement team requirements, determine any compliance and ethical issues as well as independence requirements. Ultimately, we need to establish an understanding with the client. We're going to do this primarily related to the engagement letter. In order to establish the terms of the engagement, 3 topics must be discussed: the engagement letter, using the work of the internal audit function, and the role of the audit committee. So we'll talk about the internal audit function and the audit committee in a minute, but let's focus primarily right now on the engagement letter. The terms of the engagement, in terms of what management is responsible for and what the auditor is responsible for, is embedded in the engagement letter. We'll spend just a minute or two talking about the engagement letter, and you notice the question is, who signs the engagement letter? A perfect question in regards to the CPA exam, and I think you'll be interested in finding out who actually signs this engagement letter. The engagement letter includes the arrangement for the use of specialists, any limitations of liability on the auditor or client, additional services that might be provided, as well as arrangements regarding these services. So let's talk about the internal audit function. Number 1, if there is a strong internal audit function that's independent, that's doing their job in terms of assessing the control risk within the organization, this is a strong indication of the ethical environment within the organization. The other issue related to the internal audit function is you are able to, or the external auditor is able to, use internal audit in regards to completing many of the testing from the control testing and the substantive testing. So the internal audit function can work with the external auditor in terms of completing the audit. If the internal audit function is working with external audit, the external auditor is in charge and they have the ultimate responsibility, but the internal audit function creates efficiencies within the audit and actually helps the internal audit function understand what significant risk there might be within the organization. Before the external auditor approves or accepts internal audit to be a part of the engagement, the external auditor will assess the competency, the skill set, and the objectivity of the internal audit function. They're interested in an internal audit function that is independent. They're interested in competency, so they'll assess the various certifications of the internal audit department. They'll determine if they have sufficient CPE credits. They'll determine if in fact they have the skill set to do the kinds of things that are required in regards to completing the audit. This is a systematic and disciplined approach, and frankly, if it's done correctly, both the external auditor and the internal audit function benefit from it, and clearly the organization benefits because it's a more efficient audit, it's done at a less cost, and it's done on a more timely basis. The external auditor also wants to assess the audit committee. A strong independent audit committee, again, is a good indication of a strong ethical environment within the organization. But specifically, if this is a publicly traded company or a company that is required to follow the rules of Sarbanes-Oxley, there's very specific things that are required of the audit committee. Section 301 of Sarbanes-Oxley requires the following: that the audit committee must be members of the board of directors and independent. So these audit committee members must be a subcommittee of the board of directors. The audit committee has direct responsibility for overseeing the work of any registered public accounting firm employed by the organization. And in fact, you notice that the audit committee chair is the person that actually signs the engagement letter. They must pre-approve all audit and non-audit services, must establish procedures to follow regarding complaints, maybe following hotline procedures, and then also have the authority to engage independent counsel. As we continue through our discussion through this course, what we're going to find is that the external auditor is meeting on a regular basis throughout the course of the audit to update the audit committee in regards to the progress of the audit, as well as ultimately providing the findings of the external completed audit. So now we have an engagement. We have a signed letter, and now what we're trying to do from the auditor's perspective is plan the auditor. So there's two key words here. We're looking at the overall audit strategy. We're also looking for an audit plan. The strategy is the overall strategy related to conducting the audit, and the plan is a more detailed plan related to the specific steps that we're going to complete and how we're going to be doing this in an efficient and effective manner. When preparing the audit plan, the auditor should be guided by the results of the client acceptance and continuation process, procedures performed to gain an understanding of the entity, and any preliminary engagement activities. Additional steps include assessing business risk, establishing materiality, continuing or considering multi-location situations, assessing the need of specialists, considering the violation of laws and regulations, related parties, consider additional value-added services, and then what we're going to do is document the overall audit strategy and the audit plan. So let's talk about each of these items on a specific step-by-step basis. One of the first steps that we need to understand is the entity as a whole. To understand the entity's business transactions and to identify financial statement accounts that are likely to occur. So what we're doing, in the term that we use, is gaining an understanding of the entity and its environment. By understanding the entity's business and identifying where errors are likely to occur, the auditor can allocate more resources and investigate more risky accounts. We'll talk specifically about materiality later, but we just want to make the point here that we are going to establish an overall materiality related to the financial statements, but then we're going to allocate this overall materiality issue related to tolerable misstatements in accounts and establish tolerable misstatements related to disclosures. When we consider multi-locations or separate business units, what we need to understand is, again, we need to understand the entity and its environment. Where are things done? Where are the high-risk areas? Where are the low-risk areas? Where are the moderately risk areas? So we don't want to be spending all of our time going to these locations where there's low risk. We clearly want to identify where the high risks are and spend our time related to this. How do we know this? Well, we know this by asking questions. We know this by going through this process of understanding the client. So the auditor needs to correlate the amount of audit attention devoted to locations or business units within the level of risk presented. So keep in mind that we're not going to be able to make these decisions until we understand the client. We understand how the client works, what each of these locations represent in terms of the overall structure, but we also don't want to necessarily disregard some of these locations. It's very possible that there may be things taking place in these other locations that are perceived low risk, but in fact have a significant impact on the organization. The auditor must be skilled in terms of auditing. However, the related issue is the fact that the auditor may not be skilled in every specific aspect of the audit. So what we need to do is we need to determine the need for specialists. So this is a major consideration in planning the audit, is related to specialists. Some of these specialists may be specifically related to maybe an IT specialist that can assess the general controls and the application controls of the computer systems. The presence of a complex information system may require the use of a specialist. What other types of specialists may be needed? There may be specialists that are required for inventory, valuation of inventory. If you're doing, as an example, an audit of a diamond retailer, it's very possible that you don't have the skill set in terms of understanding the value of the inventory. You would bring in a specialist that would help assess this specific piece of the audit. But again, you're in charge and you are simply allocating certain needs based upon the considerations of the organization to a specialist. We want to consider violations of laws and regulations. Now, this is a key thing. Illegal acts, not a good thing. We need to consider these from a materiality perspective, but we also need to consider this from direct or indirect. Direct and material, we consider laws and regulations as part of the audit. So if a violation of the law creates a material impact on the financial statements, it's direct and material. This is something that we would be concerned with. But we're also concerned with these items that have an indirect effect. Be aware of what may have occurred. Investigate if it's been brought to your attention or if you identify it during the course of the audit, and determine it may not have a material impact for this year, but the indirect effect of this illegal act or compliance issue may in fact have an impact on the overall structure of the organization, and certainly it may impact your understanding of the ethical environment within the organization. Information of circumstances that may indicate illegal acts, unauthorized transactions, improperly recorded transactions, or transactions not recorded in a complete or timely manner. Maybe there's large cash transactions where the notes associated with these transactions don't really fit the circumstances of this transaction. Any investigation by a governmental agency, an enforcement proceeding, or payment of unusual fines or penalties would be considered information that we would want to investigate related to these potential illegal acts. Large payments, specifically cash payments, or large payments where there's not a lot of information that we understand what's taking place. Sales commissions that appear to be excessive, large payments of cash, unexplained payments to government officials, or failure to return tax returns or pay governmental duties. Related parties is something that we are considering in the course of the audit. Now keep in mind that related parties, there's nothing illegal about related parties. However, related parties, when you have transactions that are occurring between two organizations where there's a relationship, maybe there's an ownership relationship and equity, or you have consolidated financial statements, the issue is this adds to the complexity of the financial statement audit, because what we need to do is we need to extract out those transactions between these related parties, because they're not arm's length economic activities that should be reported as revenue or expenses. The other issue is related to related parties, that if an organization wanted to hide expenses or overstate revenue, the easiest way to do this is through a related party. So as we're considering these related parties, and again, we're considering these, we're not assuming that they're illegal fronts, but what we need to understand is this adds to the complexity, and this adds to the potential that there might be illegal or inappropriate activity taking place. Let's talk about the process, and this is probably one of the most important slides that we have in this presentation. In this process, we are going through very specific steps. The first step is our risk assessment procedure. And the risk assessment procedure is we are gaining an understanding of the client and its environment. We're understanding the internal control structure within the organization. Very important, because this essentially sets the stage for the next piece. And the next piece is our test of controls. The test of controls is evaluating the effectiveness of both the design and the operation of our internal controls. The risk assessment and the test of controls contributes to our understanding of what we call the risk of material misstatement. The risk of material misstatement will determine the type, the amount, and the timing of our substantive procedures. In our substantive procedures, we are completing these procedures to measure monetary misstatement. In our substantive procedures, we are detecting material misstatements in transactions, classes of transactions, account balances, and disclosures in the financial statement. Keep in mind, risk assessment, test of controls, part of our understanding of the risk of material misstatement. It's only by completing our substantive testing that we're able to measure monetary misstatement. And it's our substantive procedures where we determine the fair presentation of the financial statement. So let's talk specifically about the audit testing that we're going to do. So we're going to document the overall audit strategy. We document the overall strategy primarily by understanding the risk, understanding the control process, and from here we are determining the nature of our substantive testing, the timing of our substantive testing, and the extent of the substantive testing. These three terms, nature, timing, and extent, are things that we're going to be talking about throughout this course. And I think what you'll understand is, as we're going through this, is the risk associated with the internal control structure will determine how we actually complete our substantive testing, where we are attempting to measure our monetary misstatements in both the transactions as well as the account balances. We're going to continue this discussion later on, But for now, this is the completion of this discussion, and I thank you very much for your time.